Hi, and welcome to this WAFA event. My name is Caroline, and I'm a co-president of WAFA. WAFA is a nonprofit with the goal of accelerating the success of female founders and funders. And I'm super excited to have WAFA's co-founder here, and she is going to talk about fundraising for startup. Alice, welcome, and I'm going to hand it over for you to introduce yourself and your co-host.
Sure. Thank you so much, Carol. Hi, this is Alice. As I mentioned, I think there are many familiar faces here, but for the ones who don't know me, I'm Alice. I'm one of the co-founders for WAFA, very dear to my heart of this organization. I'm also the founder of My Pocket CFO, which is a all-in-one place platform to manage your finances for startup founders. So I'm here today to share some tips and best practices to get your financial ducks in a row if you are planning a fundraising within a year's time frame. And I'm very honored to have a guest speaker, my friend Ashley here. I started working with Ashley about, I would say 6 months ago. And now she's, fast forward, she's on her way to $1 million revenue only in her second year of running the business. She's a rock star. And together we have overcome many challenges of getting her financial ducks in a row. Everything looks, in order, and she's about to take off and get the fundraise. So I'm super excited to have Ashley here to share a case study. Hopefully there will be some takeaways and lessons learned. Ashley, you want to say hi?
Sure. Thank you so much for the wonderful intro, Alice. So I'm Ashley Nicholson. I'm the founder and CEO of BTR Nation, and we are a functional snacking company on a mission to end mindless snacking. So we make a variety of on-the-go snacks. We started with protein bars, and this year we're expanding into the chocolate world. And we are on our way to $1 million this year. So, and it's a very small, lean team. So I'm the only full-time employee, but my Pocket CFO and Alice and the team at My Pocket CFO has been pivotal in helping us just be more confident in our numbers. And we're in the middle of a funding round right now. So we opened our seed round earlier this year, and we actually just kicked off an equity crowdfunding campaign in Republic. So all with Alice's help, and thank goodness for My Pocket CFO, because I'm in it every single day. So excited to share more.
All right, thank you, Ash. And then I would say, in terms of the format, just to get a few house cleaning items out, I would say I will start sharing, I would say at high level, some of the key elements to get your financial in order for fundraising. And then after that, I will basically talk with Ashley. We're gonna do a case study in terms of how she actually did that. And after that, hopefully we will have plenty of time to open the floor. My goal is to make this more like a, I would say, live workshop. So I assume most of the people here are founders. So I would love to hear your, I would say, share your pain points, challenges, and we can have a live discussion where I hope to be able to add some value to manage your finances. So that's how we're gonna go. And before I start sharing, I would like to do a short poll first, so I can better understand what where you're coming from, and so I can tailor the topic more specific to your needs. So the first poll is, what type of company have you founded? And there are 3 choices. One is e-commerce, second is SaaS company. I understand many of the founders here, they may come more from a software tech platform, or other type of company. And the second poll question is, are you planning to fundraise within a year? Yes or no? So I'm launching the poll right now. If you see the poll, if you could just take 10 seconds to respond, that would be great. Do you see the poll?
No.
No, I don't see it.
You don't? Carol, that's where I may need your technical help. I click launch poll. You know what? If you don't see it, let me just type in the chat box.
Or Lori, could you try launching it?
So, oh, here we go. Yeah, I guess Lori just launched it. Thank you. Great. So we definitely have quite some SaaS companies here, about 60%, at least from the respondents are running a SaaS company. And about 75% of you are planning to do a fundraise within a year. Okay, that's great. That's good to know. So I'm gonna close the poll, and then we go right into some knowledge sharing first. Okay. So let me share a simple slide that I prepared for this. Sorry. I don't know what is that. So I prepared this slide deck, and I'll just quickly go through that. Can you see the slide deck? Okay, great.
Yes.
Okay, so a little bit about me and my professional background. So pretty much in the last decade, I have been serving more or less in a finance role, as I would say in the capacity of either CFO or VP of finance or corporate finance or corporate dev in various big or small companies. I started, I would say, from McKinsey, more work for big Fortune 500 companies in their planning budgeting department. And then later on, I switched to work in smaller startup companies, I would say including tech companies in the Bay Area. Also, I was helping e-commerce company, DTC brands, to manage their finances, as well as helping them to do the fundraising. So I would say over the last few years, I have helped CEOs and founders to raise over 15 million institutional VC fund, as well as over 10 million alternative financing round, as well as helping founders, I would say, getting ready to do the fundraising, sometimes helping them to pivot to a new business, new product, sometimes help them to turn around, especially from finance perspective. So that's about my background. I would say, basically, I started hating finance, but now after so many years, I know finance so well. I almost just by reading some numbers or looking at your accounting book, I can pretty much tell the financial health of your company. So my mission right now is, because of my passion for, I would say, small startup founders, I would love to basically help you to get your financial ducks in a row. I think that matters, and that could be your superpower when you go out and start fundraising. Because as far as I can see, most of those early stage founders, they don't have, they're not financial professionals. They have less knowledge. They're less knowledgeable. So if I can empower you in this aspect, I think that will be a great advantage for the founders, right? So anyway, to cut the chase, there are 4 key financial elements to take care if you're planning to do a fundraising within a year, in my view. First and foremost, you need to get your financial foundation correct, which is most of the institutional financial VCs, they would require you to do accrual-based bookkeeping. I understand many startup companies, you start just doing cash-based bookkeeping. When you're getting ready to do a fundraising, it is necessary for you to switch to accrual-based. And we can talk in more details about what is the implication to switch from a cash-based bookkeeping to a accrual-based bookkeeping. And the second element I would say is get your cash and working capital management done properly. Cash obviously is king, especially in today's macroeconomic environment. It is really crucial you know what's your cash like inflow and cash outflow. If not on a daily or weekly basis, at least on a monthly basis, you should have a clear picture of your cash situation on a month by month basis. Especially for e-commerce company, I would say working capital is very crucial because a large portion of your cash will be food to the co-packers producing goods. And sometimes that turnaround time could be months, right? So it's really crucial you plan your working capital in advance. And because of that, oftentimes you will probably need working capital financing. And there are two types of working capital financing from my perspective. The prevailing ones, one is revenue-based, like Shopify Capital, like Clearco. They deduct your future revenue and they give you a cash advance. The other one is more debt-based financing, which could be inventory financing, your inventory PO financing, which you basically use your inventory or PO as a collateral to I would say borrow a line of credit or that sort of working capital. So we're gonna talk in more details there. And then when you are basically when you start talking to equity investment to angels or institutional investors, I think in most of the cases, they would ask you for a forecasting. If it's not multi-year forecasting, at least you should have a next year, 1 year forecasting. I would say the common mistake some founders make is sometimes they use a I call top-down approach to do the forecasting, kind of like this is how many users I'm going to acquire for the next year, or this is the target market share I am going to get in next few years. My recommendation is I think that the right way should really be more of a bottom-up forecasting, meaning focusing on where you spend, like if you're going to forecast sales, focusing on the specific channel. Is it online, Shopify channel or Amazon channel, or the retail channel? Like really go into the nuts and bolts of how you run business to do a bottom-up forecasting versus a top-down forecasting. And the fourth element is really about you should know your numbers anywhere and anytime. If not all the numbers, you should really know your key metric, some of the key sales and expense numbers. That will definitely make you stand out. And I think Ashley can attest to that, right? So those are the 4 key elements, I think, at a high level, in my view, as a founder of an early stage company, you should take care of before you start or kick off your fundraising. And then a little bit more specific, I would say, when it comes to accrual-based accounting, I talk to many founders. I think what is accrual-based accounting? Many of them actually don't know. So this is really simple, but I want to emphasize that accrual-based accounting really means you recognize your business, both revenue and expense side, when the actual event happens, not when the actual money change hands. This means companies need to record revenue when it is earned not when the money, is exchanged, right? Couple of examples for accrual-based accounting. For example, when you issue an invoice to your retailer or some of the customer, that means the revenue should be recorded. So let's say if you invoice in the month of April, that revenue should be recorded in April, even though the customer may pay back the invoice in the month of May, right? So that's a example of accrual-based accounting. In a similar fashion, when you get a bill, when the co-packer issues you a PO or a bill of producing certain goods, that means you should accrue that expense as inventory, for example, in the months when you get the PO or the bill, right? And then the third case could be, for example, when you sell product on your website, either through Shopify or Amazon or some other wholesale or retail website, typically revenue should be recorded, right? So those are just some simple, I would say simple examples of accrual-based accounting. And typically when we say you should record as accrual-based accounting, that introduces complexity in bookkeeping. That's because not only you have to record the revenue or expenses when the event happens, you also have to reconcile when the cash exchange later on. For example, when you issue an invoice, the customer pays you, a month later, then you have to go into the accounting book to reconcile an incoming payment with an open invoice, which was issued maybe the month earlier. So that introduced complexity in doing your bookkeeping properly, right? The same way with outgoing payment, you have to reconcile when the actual cash, when you actually pay some vendors, you have to reconcile with the bill or with the PO they issued earlier. The other third, I would say the third example of a reconciliation between cash transaction and a actual event transaction, revenue or expense transaction, especially for e-commerce company, would be you have to recognize the cost of goods sold when you sell a product, especially for like online sales. It's really easy, for you to collect all the revenue from Shopify or Amazon. It's probably pretty challenging for you to recognize at the same time what is the cost of goods sold of all those products you sold online, right? So those are some of the, I would say, complexities that are introduced when you shift from a cash-based to a accrual-based bookkeeping, right? And once you take care of that, I would say, or only if you take care of that accurately and avoid the data garbage in, garbage out in your accounting book, we can do a proper cash and working capital forecast, right? If you reconcile your cash transactions with all those recognized revenue or recognized expense, that's where we can accurately forecast your, future cash inflow, future cash outflow, and properly forecast your need for working capital, such as inventory, right? And when we can properly forecast your cash and working capital, I would say that gave rises sometimes to the need to do an alternative financing. For example, if your forecast, you're gonna get a lot of invoices, you're gonna issue a lot of invoices, or you have issued a bunch of invoices, but it's just the customer, especially for e-commerce, like some retail customers pay in like 60 or 90-day interval. In that case, you have great sales, but you may be tight on cash. So that could be actually a good way to get some revenue-based cash advance financing, for example, from like Shopify Capital, right? The other type of, I would say, alternative financing is debt financing. This has something to do, I would say, especially for e-commerce companies, oftentimes you may want to get some kind of financing to foot the bill for your inventory production, right? Or bills financing. There are plenty of digital financing companies or offerings out there. And we can talk in more details right later. And then the third element I want to just explain a little bit more is the bottom-up forecast. Again, just to clarify the concept, a top-down forecast offers a prediction of how much typically it goes by like how much market share you're gonna take or just the number of customers you're going to acquire. But a more accurate, a more meaningful forecast for your business, which may give you more insights about how you tweak your business levers. I would really recommend you to do a bottom-up forecasting because that offers an understanding of which business activities or levers will have the biggest impact on your financial outcome, right? So some of the examples of bottom-up would be if, let's say, if you're an e-commerce company, if you're omni-channel, right, multi-channel company, it's really worth to take a look at your sales by channel and look at your historical channel performance, for example, month by month or even week by week, and really to see if you can tweak certain channel levers and forecast the sales by channel of next year, how it's going to look like, right? Same way with expense. I would recommend when you forecast expense, go forecasting by expense by vendor or expense by category. That will shed a lot of insights on, for example, you spend a lot of, I would say, cash or money with this one co-packer or this one vendor, let's say shipping vendor or some other vendors. And that gives you, I would say, clue in terms of how you could optimize certain spending in the coming years. And the third element I want to mention is, I think it's really important if you plan for a fundraise, it's important, and this is what bigger companies typically do, what I used to spend, half of my time on with bigger company is to time or face your growth. I think it will be, it would be great storytelling if you can show kind of like a hockey stick, or staggered growth quarter by quarter to the investor. And that's why I think it's actually very meaningful and important for you to plan your financials a year ahead of the time before you start raising, because a year ahead you can plan and you can actually, to some extent, you can time your growth. In that way, it's more, controlled, or I quote unquote controlled or managed growth. You can show a staggered growth quarter by quarter to the investor, and you can time the peak of your growth, time that together with the timing of your fundraising to maximize your potential of getting, FOMO or getting attraction from the investors. So those are just some of the examples where I think a bottom-up forecast will be impactful and meaningful. I think that's pretty much, I would say, in a nutshell and very high level, I want to share about the key elements of getting your financials in order, right? So I'm gonna pause here, and if you don't have burning questions, if you do have, feel free to type in the chat box or raise your hand. If don't, I would actually like to move to a case study with Ashley. What do you guys think? Okay, all right. Okay, Ashley, are you there?
I'm ready.
Okay, great. So I just, I went really quick on the 4 elements. It's really the 3 elements of getting financials in order. I know you have gone through pretty much all of them in the past 6 months while preparing for your fundraising. So maybe we just go back in your time, like six or 7 months earlier when we first met, right? Can you share your your experience, or maybe to start with your pain point, I would say half a year back when you were planning to do a fundraise, right?
Yeah, absolutely. Where do I start? So definitely as a solo founder. So that's also one thing that I've come across a lot is as a solo founder, we're omni-channel. So we have, like Alice has been mentioning, we have 3 different channels of revenue. So we have our own website where we sell D2C, we sell on Amazon, and then we also sell retail wholesale. We sell through distributors. So there's lots of third parties involved. We work with several co-packers, ingredient suppliers. It's not too complicated, but there's just a lot of moving pieces. So one of the first pain points for myself was really just figuring out how to do my accounting and bookkeeping, because I was handling that all myself. And then I was like, okay, it's fine, I'll bring on an accountant. But the accountants that I brought on just had no idea the aspects of the business. Essentially, they were like, oh, it's great, we'll file your taxes, this looks good. So they did like a really quick audit. And then when I, met with Alice and the team and realized that like it was okay, like my books weren't a complete mess, but nothing, like some things were cash based, some things were accrual based. It was just all very confusing. And I just wasn't able to tell the story accurately as I was starting to craft my pitch deck and go out to investors, because I had no clear view of my expenses. I had a very clear view of my sales and my top line sales, but COGS and everything, there were just so many complications there. And that is what my Pocket CFO was able to solve for very quickly, as opposed to me trying to break down everything in QuickBooks. I'm the sales and marketing arm of the business. That's my specialty. That's my area of expertise. So, sales and marketing going great. We're bringing in all this revenue, but because there's so many moving pieces, cash flow was really tight. I'm like, okay, this is a great time to raise, but my numbers weren't in the right place to be able to tell the story accurately. And that was, I think all of those pieces in combination, those were the biggest pain points at that time.
All right, that's great. I remember it took us some time to sort out the monthly closing routine. Now we're kind of on the routine, like we can close pretty much like first week.
Yes.
Okay. Right. Yeah. Okay, cool. So once we get that accrual based like accurately and in time close, I remember we also spent quite some time because you were running tight on cash because you're introducing new product line and you're basically like footing the bill for the co-packer, and because of the supply chain issue, right, still running. So constantly you're having cash issue, working capital. I remember we spent quite some time, we actually sorted out. I think that's where you and I started kind of sort out, especially about all those digital lenders on the market. There are so many of them. Can you talk about that experience? I thought right now we actually have pretty clear picture on what you need, and you ended up picking 2 of them. Right. So can you share your experience on that and maybe takeaways?
Yeah, absolutely. I think it was as such a young business because 2021 was our first year in business and we were doing well in revenue. We closed the year at just shy of $250,000, but for us, it was actually more of a challenge, just like the length we were in business, because we had a little bit of revenue history, but a lot of especially debt-based financing, banks, small business loans are all looking for like 2 to 3 years in business. And that was so that we were kind of just like closed at the door there. It was just like not really an option. And then for e-commerce companies, there's just a ton of these, like Alice had mentioned, Shopify Capital, a ton of things to help finance your marketing initiatives based on your revenue. So we had really good revenues. So that was helpful that we could, pull from those alternative lenders for that. But there was all these different caveats, like some of them had exclusives, like you can only partner with one particular lender and you could never take Shopify Capital. So Alice and I were able to really like build this treasury of what are the pros and cons of each of these lenders, and what are the interest rates, what is this. I'm a pretty risk averse founder, so I'm always looking at making sure that obviously there's enough cash in the bank, but also we're not paying like 40% interest on things. So really making sure and doing my due diligence there. So it's definitely challenging because there's so many out there. and they promise a lot, but it's definitely a bit challenging. Like once they evaluate you, they do the underwriting process. It's, you think, your revenues are really great. And then they're like, okay, here's $10,000, which is really like a drop in the bucket, especially for, I don't know if there's any food and beverage founders on the call, or even just like any CPG brands that are physically selling product. It is a challenge. You've got expiration dates and shelf life and so many things to deal with. The other thing at this time was, for all those that are e-commerce businesses, negotiating terms with your co-packers, with your ingredient suppliers, that was super helpful for me as well. So, but that also, it brings in this extra layer of complication that, thank goodness, I have this accrual-based system through my Pocket CFO. I have terms that are like so crazy. It's like 30% deposit, 40% upon ship, then 30% net 30, and then sometimes it's net 15. So it's so complicated, and being able to kind of just plug all of that information into my Pocket CFO has just been very helpful for me to just do this quickly without having to hire a bookkeeper, hire an accountant who just like doesn't really understand the basics of the business. But yeah, happy to go into more detail about the specific lenders. We use Shopify Capital, and now we just onboarded with Wayflyer. But some lenders also, like Wayflyer, you need to show that you're doing $20,000 a month in recurring revenue just in one channel. So we were doing, $40,000, $50,000 a month in one channel, in our channels combined. That wasn't good enough. So there's a lot of different like caveats involved, but they are really good ways to get some capital, get some more working capital into the bank.
Great. It sounds great. I know Nancy asked about the list. From my knowledge, there isn't such a list. So actually, Ashley and I, we literally built the list, right? I'd be happy to share afterwards if you send me a private email. But that's where I see it's challenging for founders if you are looking to sort out those different lenders, because the terms are also pretty opaque. They could probably say something on the website, but there are a lot of underlying or hidden terms, which you have to be careful when you compare or talk to them. So anyway, feel free, Nancy, to reach out to me offline, and I can share the list. And Ashley, I want to ask you one more question is, especially recently, right, you are talking to institutional VCs. By the way, Carol, I saw you asked the question about all of those. Is it important just for Series A or pre-seed? I would say probably like previously we would have thought you don't have to prepare all this until you hit Series A, until you hit like $1 million revenue. But from my experience working with early stage founders, it seems to me like I think it will at least be your advantage if you get all those ready, even for a pre-seed or seed round. And for Ashley, maybe you can share your, like, even to go on a crowdfunding platform like Republic, they're asking for you to, like, so many financial docs to you have to prepare to get it ready. So from whatever I could see working with early stage founders, I think it definitely, I would really recommend you actually get all those ready before you do any sort of fundraising, starting from pre-seed. Ashley, what do you think?
I think so as well. So we're raising a seed round, and I was really surprised. I think you were surprised, Alice, too. We did some really intense due diligence for a micro fund, because I'm not approaching VCs just yet, because I want to make sure we're at that $1 million mark. I want to make sure we are profitable. That's super helpful in this type of market that we're unfortunately in at the moment. But I definitely agree with you, Alice. I think that it is so much more to your advantage, because investors are just constantly looking at so many different companies and evaluating them in different ways. And if you know your numbers, that's already your competitive advantage, because so many people are providing like maybe a P&L, maybe a balance sheet. But if you can do, like we did a huge forecast from 2022 to 2025 of my entire P&L. And that wouldn't have been able to be made possible without, your forecasting expertise, Alice, but also my Pocket CFO to be able to, gather all that data. And that was so immensely helpful. And I had no idea that they were going to ask for that at, I'm raising between 300 and 500K. Like, it's not even a huge round. So, and they still wanted that information. And then Republic and other crowdfunding rounds like WeFunder and Start Engine. And I mean, there's just so many out there right now. Republic does very intense due diligence. So we had to provide P&Ls. I mean, we're getting our Form C filed. So there's just so much that I think you would need all of your financial ducks in a row to be able to pass their due diligence round.
All right, cool. Any other, Ashley, any other tips or takeaways? I know this is more really high level. We're just trying to hit all the key elements, takeaways, tips, best practices. Any other things in terms of preparing for fundraising you'd like to share?
Once again, where do I start? I do see a question in the chat bot about metrics for different types of companies, especially like if you're pre-revenue and especially if you're SaaS and more user-based and whatnot. So I mean, I'm happy to chat more. The fundraising process for e-commerce and D2C companies is very different than tech and SaaS. So I'm happy to chat offline as well about with anyone that is an e-commerce company and wants to talk a little bit more about that. I'm not as well versed on the tech SaaS side of things, but it start before you're ready. I guess the biggest thing, probably the mistake that I made is building the investor pipeline. So I know there was like 75% of people here that said they're raising within the next year. And I come from a CPG background. So previously I worked at a supplement company for 4 years and I just did not do a good job at building my own investor pipeline and networking, because all of our funding so far has come from angels, and which has been wonderful because they're strategic angels and strategic partners. But I'm seeing a lot of the introductions that are being made are through other founders. Like that is where it's, founders are like getting connected with founders in your space, even your competitors have been so helpful because they're willing to make intros to other people, and those people could potentially be your investors. So I think that's the outside of the finance piece and knowing your numbers, build the pipeline as early as possible. So we're starting to do that now for Series A. So I am starting to talk to institutional VCs, not for this round, but for like 2020, I say 2023, but we'll see where the market is in 2023. So more towards like end of 2023, 2024 for a Series A.
Got it. No, that's super to the point. I also would like to add that I think start building your investor network should probably start at least 1 year earlier as well, and treat it more like a sales funnel. You literally have to probably track your progress with that network, right? And the other thing is, I think Ashley and I we talked about when you start with investor networking, and you probably want to start with angels first, and there are different investment vehicles to go with different phases. Like with angels, you probably want to do safe. And then there are other vehicles like the crowdfunding platform you could go to. There's also angel list, there's syndication. So I would say be mindful about, because this whole thing could swirl into a huge administrative task, like a full-time task for you. So be mindful about managing different batches and different groups of investors. Ashley, right? I think you're right in the middle of that. This so dear.
Yes, it's and it's never too. I see the comment in the chat bot as well too. It's never too early to talk to VCs as well, because to definitely connect with your angels that hopefully they have VC connections, because they're the ones that are going to help get that intro for your next round. So I'm taking calls, like some of my calls are to actually close and to bring them into the round. And some of my calls are literally just to network and connect and like stay top of mind.
Right. And you may have to offer different valuation or different discount for like if you stage those investors into different buckets and different time, right?
Totally.
Okay, cool. All right. With that being said, I know this is more of a high level overview of the landscape and key things you need to take care. I think we should open the floor. What do you think, Ashley?
I think so. Yeah, there's already some good questions in the chat box, in the chat.
Okay, let's open the floor. Let's try to address the questions in the chat box, but in the meantime, feel free to, Carol, how would you like to go with Q&A?
I think maybe it's easier if people just unmute themselves and ask the question.
Sure, go ahead. Anyone wants to ask a question? Feel free.
I would love to ask a question really quickly. So if we are pre-revenue, it's good to keep track of our outgoing expenses, but we have no incoming expenses. I guess that's a big takeaway here today.
Yes, I would say if you are pre-revenue, yes. I think it's okay. You can probably do cash based if you're pre-revenue.
Mhm.
And I know, especially in tech space, even if you're you could have already raised some money, like could be pre-seed. In that case, it's okay. You can just go with the simplest way, which is more cash based. If you can manage by yourself with QBO, I think that should be okay. But it's really about when you start generating revenue and when you're trying for the next revenue based round, you should switch to accrual and take care of some of the key elements I mentioned earlier.
Thank you. When we get there, I'll watch this recording. Thank you.
Sounds good. All right. Any other questions? I'm looking at the chat box as well. I think Mark asked which metrics are important for investors. I think obviously in the early stage, it's always the growth. And sometimes it like Ashley said, it depends on what type of company you have founded. If it's e-commerce, obviously sales by channel, right? And then Ashley and we talk about, if you position your brand more as a DTC brand, then obviously Shopify and like Amazon, those direct channels would be important. If you position yourself more as an omni-channel, then it's more across both online and offline channels. If you're a SaaS company, obviously we are going to look at repetitive subscription numbers. So it all depends. And Mark, if you want to chat offline, be happy to have a chat, look at your specific use case. But that's the top line. But regardless, I would say the bottom line is always, again, if you're a tech company, like your R&D basically is important, R&D spending, and your sales and marketing, like what's your CAC, what's your customer acquisition cost, what's your unit economics. Those are some of the key metrics you may want to pay attention. Hi, Lori, go ahead.
All right, thanks, Alice. I have a question for Ashley. So Ashley, when you're talking about building your pipeline, right, can you talk a little bit about what that experience conversationally was like? Like, what kind of conversations are you having? What are you revealing about your business to people who, I assume you're not having everybody sign an NDA, and if you're already public, if you're already out there selling in the world, it's a bit different. But can you talk a little bit about, what are you trying to accomplish? How do you initiate the conversation? What do you reveal in a conversation? Those types of things.
Yeah, absolutely. I wish I was a lot better at this. This is probably the part that's the most challenging. Most of the conversations that I'm having, I'm closing. It's actually getting the conversations. So I've been leaning a lot on different organizations and my founder friends to actually make intros to angels. Because for us, when you're approaching VCs, you can do some cold outreach, but angels are harder to find, especially in CPG. So AngelList has not been the most helpful for us. So like literally, you could be stalking people on LinkedIn. I put that in air quotes, just like trying to find someone that, because like sometimes people will have in their bio angel investor, and that's helpful, but most people don't have that information. So really finding people is through other people. That's literally what I've been learning, is that, just putting it out there in the world that, okay, we're kicking off a fundraising round. And, I had 5 of my founder friends say, oh, I know so-and-so who, is interested in investing in a snack company, and like, let me make an intro. And that's how I've been gathering, these conversations and really starting to have them, which has been very helpful. Mm-hmm. The other thing, I'm an open book. I probably share too much, but I do share. I like to be very transparent about our business, because I want people to know, like, this is our traction, this is our growth rate, this is how we're profitable, and this is, what it looks like to date, and this is what it's going to look like in 2-3 years. I also see a lot of food and beverage companies specifically that are like, okay, yeah, we're going to be making $100 million in 5 years. Like, that's not realistic. I've grown a company to almost $20 million. I know what that feels like and how hard that is and how long that can take. So it's not that simple for food and beverage companies to do that. So I try to be as realistic as possible, and hoping that it's not going to like shoot me in the foot. So essentially, I'm usually sharing very high level documents first. So I always share the pitch deck first and foremost. I probably should put an executive summary together. I have not done that, but I share our pitch deck. And then if there's further interest, then I'll I have a whole data room that has our P&Ls, that has our forecast, that has our marketing strategy, all of those things in one spot. But then one thing that Alice taught me is that we should be really doing due diligence on these people as well, because they're coming into your company and they're taking equity. So being mindful of that and starting to ask them questions as well. So that's something I'm getting better at. But I do, as long as we're going to that next step, I feel pretty comfortable sharing our P&L, sharing our balance sheet. And when you're crowdfunding, you're pretty much exposed and out there, because everyone can see your Form C, everyone can see like where you're at, what the valuation is. So I knew if I was going to go into the crowdfunding that route, that I would need to be pretty open anyway. So I figured, okay, let me share as much as possible to tell the story as best as possible to bring people in and get some more working capital under our belts.
Cool. Thank you very much.
Yeah, of course.
Right. Any other questions?
Well, I'll ask one more. Ashley, if we want to connect with you offline, how do we reach you?
Yeah, absolutely. So I am Ashley Nicholson on LinkedIn. So our company's name is BTR Nation. So our website is BTR, B as in boy, B as in bold, T as in tenacious, and R as in resilient. So that's actually the acronym for the company. So btrnation.com. And I am the sole full-time employee at the company. So you will always find me, whether it's on Instagram, whether it's on LinkedIn, Facebook, all of the things. And then I'm also at ashley@btrbytes.com. So if anyone, like I said, e-commerce related, I'm happy to share. Like I said, I'm an open book and happy to share all of my experiences with alternative lenders, what Shopify Capital looks like, all of my experiences there.
Thank you. I'll be reaching out.
Awesome. Thank you.
Awesome. Okay. Carol, I think if there's no question, we can close a little bit early. Again, I can type my
Alice, there was a question here. What is the CFO Pocket platform?
You mean
my Pocket? Yeah, what is My Pocket? We heard Ashley talking about it in terms of using it, but can you talk a little bit about specifically what your product is, your service is?
Yeah, well, so it's an all-in-one platform. It automates your bookkeeping to start with. So instead of hiring an accountant to do your accrual-based accounting monthly or sometimes yearly, quarterly, it's a DIY platform. So you can think of Shopify for to manage your finances. So DIY to get your finance done. And then we have a team on the back end basically tracks and reminds you of things you should be aware of. Right, so so that's where basically Ashley started working with me and using my Pocket CFO to take care of her to get her accrual-based finance done first. And that's almost real time. It's like once we connect with all your transactions, it gets done automatically on a daily basis. So you could see all your financials reflected in your financial statement, almost I would say real-time basis. You could see your consolidated sales, expenses, working capital on a daily basis. So that's the starting point. Right now we're actually in a pilot phase. So it's I think we're doing a beta, only doing a beta launch, targeting beta customers. So if you are interested, send me I would say email offline. I'd be happy to do a demo. I'm also doing a special, I would say special offering for this community. It's $99 per month for 3 months, and after that it's $199. So instead of hiring a content, paying a couple hundreds, you can try this platform to automatically get your finance basically taken care of. But regardless, I think this webinar is not about selling the software. I'd be happy just, I think, to get Ashley here for us to share a few tips. If you want to ask more specific question, I'd be happy to share more. I think Ashley would be happy to do the same, or share the vendor list or financial due diligence list we have with you. So just feel free to reach out offline if you are interested in talk more. And thank you, Lori, for asking that question.
Thank you, Alice.
One thing I'll actually add as well is, as founders, we're, even if you have a team of 5, 10, there's so many hats that we're wearing. And I thought that I could handle the finance hat as well on my own. And, going into QuickBooks once a month or every week, I mean, I was still spending, like, putting journal entries together. I was still, spending 8+ hours doing that. Whereas now my Pocket CFO, every time I have a call with Alice, I make sure that everything's reconciled. Literally takes me like 10 minutes. So I'm usually not the person to say, like, oh, I'm going to get this software and I'm going to spend money on it because our cash flow is so tight as it is. I'm always spending money on inventory. Literally everything is about inventory and making sure, because we're always out of stock because the demand is so high, which is wonderful and a great problem to have sometimes. At the same time, it has just been such a worthwhile investment, because I am getting literally like 7 hours a week back into my life, which is super helpful. So I forgot to mention that part, but usually as founders, just our time is so valuable, and sometimes we don't price it. But, if we put a value on what that's worth, and to be able to just, take 7 hours or 8 hours of time and put it into 10-15 minutes, it's been super helpful.
Last question on my Pocket CFO. Does it replace something like QuickBooks, or does it communicate with something like QuickBooks?
That's a great question. It does communicate. So we work like a digital accountant or a finance manager. So we auto generate entries, journal entries into QuickBooks. QuickBooks or Xero or any type of accounting system would be your system of record for your accounting book. We don't replace that. What we replace is the labor work you or any accountant would do in getting your accounting book closed or in order. That's the work basically that's the 7 hours of work Ashley was talking about.
Fantastic. Congratulations to both of you.
Thank you.
Thank you. All right. I think we're right at the time. Again, if you do want to have further questions, want to chat offline, feel free to. I saw Ashley, you have your email there as well. Feel free to reach out to either one of us. Best of luck on your startup journey, and we hope to see you again. Hope we could be of some help.
Thank you very much.
Thank you, everybody. And I will follow up with a email with the recordings and a survey.
Thanks,
Thank you.
Carol.
Bye.
Bye.
Ash. All right. Talk to you guys.